When you step on the accelerator of a Tesla or when an AI data center powers up its servers, there is an invisible switch that handles the massive surge of energy. It's not digital code, it's raw physics. It's silicon carbide. And one company has bet its entire existence on mastering this material. ON Semiconductor, now known as Onsemi. Ticker symbol, ON. While NVIDIA provides the brain of the future, Onsemi provides the muscle. Without them, electric vehicles can't run efficiently, and the green energy revolution hits a wall. We have analyzed their financial journey from the massive restructuring of 2021 through the brutal EV winter of 2024 to the recovery signals in late 2025. The data tells a story of a company that ruthlessly killed its old self to build a high-profit machine. This is the financial story of Onsemi. The power behind the power. The story begins with a new captain. In late 2020, CEO Hassane El-Khoury took the helm. He looked at the company's financials in the 2020 10K and saw a bloated catalog of low-margin commodity chips. He made a bold decision: exit the low-margin business. He launched the Fab Right strategy. The impact was immediate. According to the 2021 and 2022 filings, revenue surged to $8.3 billion by 2022. But the real miracle was the margins. Gross margins, which historically lingered in the low 30s, skyrocketed to 49.2% by the end of 2022. They achieved this by pivoting hard to intelligent power. They weren't just selling chips, they were selling premium silicon carbide solutions that every EV maker was desperate for. They transformed from a commodity trader into a strategic partner. Then came the test. As interest rates rose in 2023 and 2024, the explosive demand for electric vehicles began to cool. The 2024 10K reveals the inventory correction. Customers who had panic-bought chips suddenly stopped ordering. Revenue in 2024 dropped to $7.6 billion. The stock took a hit. Critics questioned if the silicon carbide bet was too aggressive. But look closer at the financials. In previous cycles, a revenue drop like this would have destroyed their profitability. This time, Onsemi held its ground. They maintained gross margins in the mid-40s range despite the downturn. This proved that their structural transformation was real. They were no longer a fragile cyclical company. They were resilient. Now, let's look at the recovery signals in the fiscal 2025 quarterly reports. The Q3 2025 10Q shows that the bleeding has stopped. Revenue has stabilized around the $1.7 billion to $1.8 billion per quarter mark. Two key drivers are emerging. First, the EV market in China and Europe is normalizing. Second, and most surprisingly, AI data centers. AI chips are hot, extremely hot. They require massive amounts of power regulation. Onsemi's power modules are now finding a new home in the racks of hyperscalers, helping to cool down and power NVIDIA's chips efficiently. The 2025 filings indicate that Onsemi is positioning itself not just as an EV play, but as an energy efficiency play for the entire AI ecosystem. From 2020 to 2025, Onsemi proved that it is possible to teach an old dog new tricks. They shrank their revenue to grow their profits. They sacrificed volume for value. The road has been bumpy, mirroring the volatile EV market. But Onsemi owns the essential technology, silicon carbide, that the world cannot ignore if it wants to go green or run AI. They are the gatekeepers of energy efficiency. Thanks for watching. If you want to understand the companies powering the future, make sure to subscribe.